Hello and welcome to S&W Sessions. My name is Julian White and I am a pension transfer specialist at Smith & Williamson in the Financial Services Department. I've been providing pension advice for about 15 years, both in respect of defined benefit pensions and money purchase pensions, as well as writing pension sharing reports to court. The topic of today's session is the do's and don'ts of defined benefit pension transfers. The agenda for the session is defined benefit and money purchase pensions, the basics, the pros and cons of retaining or transferring a defined benefit pension, a brief summary of the new pension transfer rules, some details about the background, landscape of pension transfers and what we think is probably a potential scandal imminently, a case study on British Steel, our view on best practice when considering a defined benefit pension transfer, and some key takeaways. Now, a quick warning before I start properly. If there's any pension experts who may be listening, I will be generalising and simplifying some technical points in order to ease understanding. Also, the first section will cover some basics, so please bear with me for a couple of minutes if these concepts are already familiar to some people. Now, there are numerous variations of pension types, but in broad terms, there are only two main types, defined benefit pensions and money purchase pensions. The two types of pension are fundamentally different. The easiest way to compare the two is to think of a defined benefit pension as an income and a money purchase pension as a lump sum. Defined benefit pensions are employer pension schemes that promise to pay a specific income in retirement once a month for life. For example, a defined benefit pension might promise to pay you an index-linked income of £10,000 gross per annum from age 65 for life. And the other type of pension, money purchase pension schemes, often referred to as defined contribution schemes. Money purchase pensions are investment funds that can be used to generate an income in retirement, either by buying an annuity, which is a guaranteed income from an insurance company, or by spending down the fund. Key point being that the member bears all of the risk. From April 2015, new regulations were introduced called pension freedoms for money purchase pensions only, which mean that there are no longer any annual income limits. Members can vary the level of income payments, stop and start income payments, take out ad hoc lump sums throughout retirement, and even withdraw their entire money purchase pension funds as lump sums. Also from April 15, the death benefit rules changed so that money purchase pension funds can be left tax-free to any beneficiary on death before age 75, even after starting to draw an income. After age 75, the beneficiaries usually pay income tax on the funds received. Members of defined benefit pensions are entitled to give up their promised retirement income in exchange for a scheme paying a lump sum referred to as a transfer value into a money purchase pension. So in essence, it's possible to swap an income for a lump sum by transferring, although this option is not available to members of unfunded public sector schemes or to members with pensions in payment. So as money purchase pensions offer pension freedoms, whereas defined benefit pensions do not, there are some potential advantages to transferring. However, by transferring, the member takes on from their former employer all of the investment risk in retirement, plus the risk of living longer than expected and either running out of money or having to reduce the income payments in retirement. So this slide shows some of the main features of retaining a defined benefit pension, and one of the main features is that you would receive a regular income payable once a month into your bank account throughout retirement. Most schemes will offer a spouse's pension, usually 50% or 2/3 of the member's pension, so if your partner outlives you, then they will receive a guaranteed income. And there's no risk of outliving the income and no investment risk for the member. Another key advantage is the member has to make no complex decisions in later life, so if you do live longer than expected into your 80s or 90s, you don't have to continue to have ongoing meetings with a fund manager, for example. But the potential downside, in terms of some people's preferences, there's no flexibility, you can't take any lump sums, and there's no legacy, no lump sum to be left, in most cases, on your death. Now, the features of transferring a defined benefit pension into a money purchase pension are basically almost the opposite of retaining a defined benefit pension. So the income can be varied, which can be incredibly helpful, especially for people who want to retire in stages. So people who want a low income first of all, and then a higher income when they are in, if they want to partially retire, so that they need a low income first of all, then when they go into full retirement and be very active, they might need a high level of income, might want to reduce it when a state pension comes in, and dip in and take lump sums as and when wanted. In most cases, transferring will increase the maximum tax-free cash you can take from your pension, especially where transfer values are high. One of the key advantages for most of our clients who transfer is a lump sum death benefit. So on death, any remaining funds can be left to any beneficiary, and if you die before 75, that's the lump sum is tax-free. You can also change the level of income withdrawing in the case of ill health. So sadly, we have heard of a client who had cancer and actually withdrew most of their pension funds to pay for private medical treatment in America. But transferring into money purchase pension does come with investment risk. And also during later retirement, most people will suffer a degree of cognitive impairment and having to have ongoing complex decisions may not necessarily be ideal for everybody. There's also the risk of outliving the income stream or having to reduce the income to make sure you don't outlive the income stream. Now, in Australia, there's a very different pension system where the vast majority of pension wealth is held in money purchase pensions already. And there's a lot of research over there saying that it can go wrong for two groups of people. One group of people are people who are risk averse in retirement, and they will put their funds in very low risk investments, getting low returns, and will also only feel comfortable drawing 1 or 2% of the fund out a year, so end up having a much lower income than he would have got had they been able to buy an annuity. And the other group of people who draw out 8 to 10% of the fund a year, expecting that to last and running out of money in their 70s. Now, the next section is a brief summary of the new transfer rules. And the biggest change from 1st of October last year was something called the TVC, or the Transfer Value Comparator. The TVC is basically the full cost of buying equivalent benefits from an insurance company. And the idea, it's supposed to be a disruptor and to give the members a pause for thought before transferring, rather than being the absolute be-all and end-all of the analysis. So what happens, for example, is a member might be entitled to £10,000 a year pension, receive a transfer value that's £250,000, and they've never seen so much money in their life and they think they've won the lottery. So what the TVC will do will say, well, the transfer value is £250,000, but the full cost of providing the benefits is £350,000. It's shown in graphical form, and it makes the advisor have to explain to the member, what on earth's going on? Why are they losing so much money on transfer? So it isn't the basis of the decision, but it's enough to put doubt in some people's minds. Now, everything else has changed. It's really been confirmation of best practice. So there's nothing there which is anything other than good things that most advisors will be doing anyway. So the advisor should be assessing the client's intention for taking benefits, the relative risks and benefits of each option, any alternatives that could be used to achieve the client's objectives without transferring. And this is something slightly new. So the attitude to investment risk is something that most advisors do well already. What they didn't tend to do was assess the client's attitude to transfer risk. And attitude to transfer risk is where the member is giving up their guaranteed benefits and just really understanding, how they feel about that. There are also new rules setting out how to advisors who work together for best practice, where the pension transfer advisor isn't giving investments. And there was a lot of confusion about that before the new rules came in. and advisors doing different things. But basically, it's the pension transfer advisor advises on the pension transfer, the investment advisor advises on the investments, and the pension transfer advisor takes into account the actual investments that are being made, the actual costs and full charges, rather than making a recommendation about what they think the money should be invested in, which all sounds to me incredibly sensible. One key thing that came out of the consultation of these new rules really is that streamlined advice is completely unacceptable. So there were bulk exercises being done where, in order to keep costs down, to make the exercise work, advisors were only advising on the transfer on the merits of the pension issues alone, so not looking into the client's wider circumstances at all. Well, the FCA's have made it very clear that can't be done and it's completely unacceptable, so hopefully no firms are doing that anymore. Now, next slide is on a bit about the background and the landscape of pension transfer advice. So until 1988, it used to be compulsory to join your employer pension scheme. But at the time, there was a spirit of personal responsibility and freedom, and the government introduced a new type of pension called a personal pension and encouraged people to opt out of their employer scheme, take personal responsibility, and invest in a personal pension instead. And there were even adverts paid for by the government showing somebody tied to a ball and chain, and the ball and chain representing their employer's pension scheme. Now, unfortunately, this went quite badly wrong. People thought they were going to get investment returns of 10% a year, that annuity rates were always going to be higher. And lots of people opted out of their schemes and got nothing out of it in return. When everybody realised just how bad this was, the regulators at the time, the FSA, undertook a thematic review and every advisor, had to write to every single person they'd advised to tell them how to make a complaint and to ask them if they were happy with the advice given. So by the time this all unravelled, about 1 million people been compensated for receiving bad advice, and the industry picked up total cost estimated to be in the region of £11 billion, including the cost and compensation. Demand for pension transfers remained very low for many years. There are a few exceptions where people were in ill health, for example, or if they had a partner, but the partner wasn't entitled to any death benefits. Then everything changed in 2015 when pension freedoms were introduced. So pension freedoms were introduced for money purchase pensions, but George Osborne announced he wanted as many people as possible to benefit from pension freedoms, including members of defined benefit pensions. So there was a thought at the time that people might be able to take a chunk of their defined benefit pension out under money purchase pension freedom rules, but that fell through. So with most people, in order to access pension freedoms, they have to transfer their defined benefit pension into a money purchase pension. Now, the government expected a big increase in demand in pension transfers because of people wanting to access pension freedoms, and so they set up a new rule which saying anybody whose transfer value was over £30,000 needed to seek advice, get advice from a pension transfer specialist before they were allowed to transfer. Now, the regulators, the FCA, also expected a significant increase in demand and launched a consultation into improving the quality of pension transfer advice in March 2015 to encourage a discussion about what good advice looks like in the post-pension freedom world. Well, however, demand was far higher than even the FCA expected and rocketed towards the end of 2016. So this graph is based on figures from the Office of National Statistics in respect of all pension transfers, so money purchase and defined benefit pensions. And you'll see from the graph in 2015, when pension freedom was introduced, there's a massive leap in the total volume of pension transfers from about 5.4 billion of funds to 13.2 billion. Now, the main reason for this was people transferring between money purchase pensions from old contracts to new contracts in order to access pension freedoms. Now, there were some defined benefit pension transfers as well, but the bulk of that was money purchase to money purchase transfers. Now, in 2016, there was a big fall in demand for money purchase to money purchase transfers because there'd been a sort of spike in 2015. However, in the final quarter of 2016, there was a really big increase in the demand for pension transfers, defined benefit pension transfers, and this was basically off the back of the unexpected result of the Brexit referendum. Immediately following the referendum result, interest rates fell, annuity rates fell, and transfer values hit an all-time high. So many members were pleasantly surprised by the transfer values they received, and some received their transfer values about twice the amount they were expecting. Word spread of high transfer values, sometimes 30 or 40 times the gross annual income, and people started discussing transfers with colleagues at work and at dinner parties. So demand was mainly driven by word of mouth and people knowing about high transfer values and requesting transfer values. Now, most people, or many people in the industry, think that the peak was in 2017 for pension transfers, and you see from the graph a massive increase from 2016 to 2017. Now, this has fallen, it fell a bit in 2018 and continued to fall this year. And a lot of people are speculating this might be down to improved standards in advice rather than any change in demand. And also, it could be down to the costs of giving advice, because a lot of firms have professional indemnity insurance costs that have gone through the roof, stopped doing the work, or have been told by their insurers that they've got to cap the number of pension transfers that they advise on. The FCA have estimated that for the time being, they expect pension transfers to continue in pretty high levels of demand in the historic sense, possibly in the region of 20 to 30 billion pounds a year. Now, the transfer value offered for giving up benefits vary greatly. For example, for giving up an income of £10,000 a year, we've seen some schemes offer very low transfer values in the region of £80,000. Now, since Brexit, the average transfer value has been in the region of £230,000 to £250,000 for giving up £10,000 of income, and that's based on an index which assumes that the retirement age is 65, the member is 64, and the income is RPI index linked. But we have seen some schemes which are offering transfer values of a multiple of 40, so £400,000 for giving up £10,000 of income, and the most extreme case we've seen was a case where somebody was offered a multiple of 72, which would have been the equivalent of £720,000 in cash for giving up £10,000 a year in income. Now, because the demand was so high, the FCA had serious concerns about whether people are transferring or shouldn't be transferring. And in an initial stage of their review of pension transfers, they visited a number of firms undertaking high volumes of pension transfers and reviewed their files. And unfortunately, the finding was that only 47% of the files they reviewed were shown to be good advice, i.e. that the client clearly should transfer. 17% of files showed the client definitely shouldn't transfer, and about 36% were unclear. And the problem with unclear files is that if the member changes their mind and puts in a complaint, if it's unclear whether the advice was good or bad, then there's been a high chance that the complaint will be upheld. So it's a problem from the advisor's perspective. However, the thing I was going to say was that this doesn't necessarily reflect advice generally, because the FCA were specifically targeting those forms to review. So hopefully the standard across the industry is much higher than that. However, from discussions with other advisors, we have some concerns that even where the advisors are very well-meaning and would transfer themselves, that they are quite pro-transfer. And there's risks of poor decisions being made, especially in the context of where we are in markets, where over the last 10 years markets have gone up generally, and people are making decisions to transfer, saying, well, yeah, absolutely. I really appreciate it might go wrong, but actually, when you talk to them, they genuinely don't think it's going to go wrong. And when markets fall, experience has shown us that whenever they do fall, some people crystallise their losses and switch out of equities into cash. There will definitely be some people transferring who, when markets fall, will regret their decision and crystallise their losses. It's just a question of how many people do it. And also the question is, if they've made the wrong decision and they put in a complaint, will the ombudsman uphold the complaint? And one of the key things there is that if the client can't bear the risk of things going wrong, and it goes wrong, the advisor is probably going to be held accountable for the bad decision, and the ombudsman is likely to tell the advisor to pay compensation to the member to put them back in the same position they would have been if they'd not transferred. On a connected point, there's a possible risk of opportunist complaints. So if complaints are being upheld, people are being encouraged to make a complaint even when they haven't actually got any serious concerns about what's happened. A deadline for PPI claims ends in 29th of August this year. The average PPI claim is £1,700. Average estimated compensation for an upheld complaint, the defined benefit pension transfer, is £50,000. So that combination of factors is a bit concerning. Also, if you Google pension mis-selling, the top 4 results are adverts for making a claim against former advisors. And I understand there's already radio adverts suggesting that people contact firms to find out how to make a complaint about their advisors on pension transfers. On the other hand, the good news is that the FCA policy statement issued in October last year sets out exactly how to give high-quality advice, and there's no reason for any advisor to be giving advice that risks complaints being upheld. As long as the advisor follows all of the guidance in the under the new rules from October last year and very familiar with all of the guidance given in the notes, then perfectly possible to give safe pension transfer advice. But it does repeat the key thing is that most members shouldn't transfer if they've got a choice of either keeping all of their pension or transferring all of it. This does mean that partial transfers could be the optimal solution for some members who want an element of freedom, but this isn't currently a mainstream option. There's a very small minority of schemes offering it. As advisors, we would encourage employers and trustees to give serious thought to offering partial transfers, because it could well be the best option for anybody or most people considering a transfer. So keep some guaranteed income that covers your income needs, and then the rest can be flexible. Now, a lot of the discussions, a lot of the issues, that employers and trustees may be considering are covered in an excellent discussion paper that was issued in September last year that was published by Evershed Sutherland and Royal London, and it was called How Much Should You Tell Them? We would encourage everybody listening to read that. It was an excellent piece of work. A lot of the issues there that, say, employers should be thinking about. Now, some employers are actually undertaking due diligence on financial advisors to help their members find advice because they've got the resources to review the market and sometimes negotiate lower fees. And sometimes this is triggered by senior employees trying to arrange their own pension transfer and finding it very hard to find a high-quality advice for a reasonable fee. Another associated point is some schemes are including transfer values in retirement packs or in the annual review packs. Now, we have had people approach us that they're 3 months off of retirement, have never considered transferring their pension before. They really value the defined benefit pension, but have got a letter 3 months before retirement telling them they've exchanged their income for a transfer value of £1.5 or £2 million. They're quite often in a panic because they've never thought about it before, really struggle to find advice on the merits of transferring. A lot of the feedback we've got from our clients is it's very easy to find advice based on the investment services of the advisor and everything that could possibly go right. But when it comes down to a really balanced decision where people genuinely want to be advised on whether or not to transfer, they can find it a bit more difficult to seek advice. So we'd encourage any employer or trustees that are issuing automatic transfer values in retirement packs, perhaps to do it in the annual review a year before retirement, to give the members plenty of time to consider their options, and perhaps the first one being an indicative transfer value, which can help start the process. Now, the next slide is it's a British Steel, which is a brief case study on this, and it's a particularly heartbreaking story relates to the British Steel pension scheme and pension transfers. I'm sure many of you will be familiar with a lot of the coverage. So the background was that to help the long-term prospects of the employer, the pension regulator allowed the British Steel pension scheme to reduce benefits being paid to its employees. The way of doing this was to set up a second British Steel pension scheme and winding up the first one. Now, members had to opt to transfer out of the British Steel first pension scheme into the second one and receive slightly inferior benefits, but that would perhaps improve the long-term prospects of their employer. Now, anybody who didn't transfer between the schemes would remain in the scheme. When the first scheme was wound up, the first scheme entered the pension protection fund. The vast majority of people would be better off transferring into the second new scheme rather than getting benefits in the pension protection fund. But because there are a handful of members, or a small proportion of members, who would have been better in the pension protection fund, every single member had to get advice. Also, I'd make a decision, I should say, and some members sought advice. Now, the advice they received from a lot of financial advisors was to neither stay in the remaining scheme or go into the new scheme, but to transfer into a SIP instead, where the advisor could invest the funds. Now, for many people, that might well have been the right idea, but there's the risk that many British Steel pension scheme members were vulnerable clients in terms of not having any investment experience and limited knowledge of financial services. And unfortunately, there's stories of very poor practices in advice being given, including the advisor not assessing the client's attitude to risk at all until after the transfer had been completed, very high ongoing charges, high exit penalties, lots of rumours of fraud and the money disappearing, and advice being based on promises of very high levels of investment return for very low risk. The other one of often repeated stories related to unregulated introducers offering staff or steel workers free dinner down the pub in exchange for them talking to them about pension transfers. So they had the opportunity to frame the advice, convince the members that it was a great idea to transfer before referring on the lead to a regulated advisor who would then sign off the transfer and recommend an investment in a product where, rumour has it, they would either receive high levels of ongoing fees or, as I say, unfortunately, there appears to be cases of fraud. Now, some of the firms advising on the pension transfers have had their permissions removed, which may just be down to their procedures, or it may be down to poor advice. And we don't know yet, and a couple of the firms are already insolvent. Now, the employer and the trustees were criticised by the DWP Select Committee for not doing enough to help members get advice. And this is despite them appearing to have done everything required to them by the regulations, and even doing things which are considered to be good practice. And there's an independent review of the scandal afterwards, which the slide on the screen is showing, where the review found that they felt the employer could have done more to help their members seek good advice. Now, the next section is this is our opinion on best practice when considering a defined benefit pension transfer. Now, one of the strong opinions, which isn't universal across the industry, is that we feel that an expert should always give the advice to the member rather than just checking it. Now, this isn't a requirement of the regulations. If the regulator made that a requirement, it would really restrict advice and push up costs potentially. But in our view, and the view of many people, this is the most complex decision that pension scheme members will probably make, financial decision in their lives, and it's quite often the most complex piece of advice the advisor will deliver. So if people are presenting the advice, aren't pension transfer specialists, and don't really understand the risks, then there's got to be a chance, in our view, that the member doesn't really understand the full risks either. And it's one thing to review a file, but it's another to speak or ideally meet to the member and actually gauge what they are understanding and what their concerns are. The next point, in our view, wherever possible, the advice should be given on a fixed fee basis rather than based on contingent charging. So contingent charging is where the advisor won't be paid anything if they recommend that the client keeps their pension, but will receive potentially large fee if they advise the client to transfer. There's an obvious risk of it not being in the or recommended against the client's interest where there's a financial incentive to do so. A connected point is we don't think that the advice should be paid for on a commission-style risk premium. So pension advice used to be on the basis that the advisor would receive a percentage of the fund, so 3% or 4% commission. Commission had been banned, but in the case of pension transfers, advisors are charging an advisor fee quite often of 3% or 4% of the transfer value, so almost exactly the same as a commission basis. This is being referred to as a risk premium because potentially the higher the transfer value, the higher the potential complaint. But in our view, advising on high levels of transfer values quite often is much lower risk than advising on lower transfer values. So for people who have got lots of other wealth with large pension transfer values, and so they're not going to draw down on their income or they don't need the income they're giving up, is actually lower risk than lower transfer value where it's most of the client's wealth. Next point, we think it's best practice to work with other IFAs and wealth managers, and in particular it shouldn't be a condition of giving the pension transfer advice that the member has to sign up to ongoing services, because this in fact is such a much bigger conflict of interest than contingent charging. So we have cases where the advisor will receive £5,000 or £10,000 a year per year for the next 20 or 30 years. And that's more of a conflict, surely, than an initial fee. Another important point is the framing of the advice. And rather than tell people about all of the advantages of transferring, and at the end saying, well, it could go wrong, advice for us should be very much on the basis of why defined benefit pensions are really good for most members, and asking what the member is prepared to give up in exchange for achieving what goal. Also, there shouldn't be any exit penalties in our view. We don't see any reason why there should be exit penalties if the member decides to transfer shortly after, away from the advisor, shortly after initial transfer. High exit penalties quite often are a sign of high charges. Another key point is the advisor should have a strong triage process. So they should have a balanced education process about the pros and cons of all the options. That's completely neutral language that you made free to the member before they even engage in the advice process. And in the ideal world, in our view, the firm should do lots of other things so they've got a big incentive to be around and avoid any complaints. So if the advisor becomes insolvent, the member can't apply for compensation from the financial ombudsman, but has to go to the Financial Services Compensation Scheme, where rather than the compensation of $350,000, the compensation might be capped at $50,000. So where an advisor becomes insolvent, it can be the case of members looking at who else to blame. And in the case of British Steel, there's a lawyer who is looking at class action and looking at where the advisor has become insolvent, whether they can sue the unregulated introducer or even sue the discretionary fund manager who had no part of the transfer decision but has benefited financially from the transfers. So the key takeaways from today's session, hopefully, will be the first point is we would encourage everybody to read the Royal London, sorry, there's a typo on the screen, Royal London and the Eversheds Sutherland's discussion paper. We'd also encourage employers to consider offering partial transfers to members. And if they're issuing transfer values to members at retirement, rather than doing it 3 months before, to consider doing it a year before. And another point we would encourage employers to do is to consider undertaking due diligence on financial advisors and to either have a panel or a preferred advisor. Now, we appreciate why most employers are probably going to be reluctant or not want to do this, but the feedback we are getting from many clients is they're incredibly grateful when this is done because they find it very difficult to do on themselves. And the final point is that we're here to help, and please speak to us if you've got any questions at all. We're delighted to talk to employers, trustees, administrators and compliance officers, and we're very happy to provide financial education to members. For example, we're happy to provide lunch and learn talks where we explain to members what pensions they've got, how they work, why most people should keep their pensions, and explain the few exceptions where the examples of it might be a good idea for some people to transfer. So, still got a little bit of time. So there's a couple of questions I'd like to answer, which was the first question was why do transfer values vary so much between schemes? And there are lots of reasons for that. But the main one appears to be that the actuary can either base the transfer value on the actual scheme investments or on gilt yields. So with some schemes, if they're investing in equities and the actuary decides to base the transfer value taking into account the scheme investments, the transfer value can be low. But in other schemes where the actuary makes conservative assumptions, the transfer value can be very, very high. It can be driven, we think, sometimes by employer preference. So, for example, with the Barclays pension scheme, they were offering multiples, quite often for many members, of 40 or 42 times the pension income. And there are huge amounts of people transferring out, which is a win-win situation because the members got a large transfer value and Barclays got the debt off the book and improved the funding position of the scheme. The second question was whether we think that contingent charging should be banned, and I don't think that will fix the problem of avoiding conflict of interest. And I agree with everything in the FCA consultation that it's much more complicated than that. There are some good advisors giving advice on a contingent charging basis where they are taking strong action to mitigate the risks. For example, where the advisors are salaried, don't receive any bonuses, don't give the investment advice post-transfer, and they've got a clear separation between the ongoing work and the initial advice. And as I say, there's no bonuses for any of the staff for recommending transfers. And also in the case of British Steel, the review found that one advisor cornered the market by offering low fixed fees. So the implication being that banning contingent charging isn't necessarily going to be successful. So that takes us to the end of today's session. So thank you very much for listening, and I will follow up with an email to any answered questions. And please do contact me if there is anything at all you want to discuss.